So for my 2020 SRS funds, I had the option of whether should I top up my StashAway account or maybe give a shot to Endowus, which is another solid robo-advisor that's in Singapore. I think Endowus has the widest selection of products that you can get with a robo-advisor. You can invest everything from your SRS, your CPF, cash, there are even money market products that you can buy. And recently, they launched this thing called FundSmart as well, which is a DIY portfolio builder. And specifically for this review, I'll be focusing on the core model portfolio, which I decided to use to allocate my SRS funds to. I chose to use the 100% allocation towards equities, which is also its highest risk profile. That's somewhat similar to what I did with StashAway, where I used the 36% StashAway risk index, which is the highest risk as well. I'll be covering the core things that you should know about Endowus, how they kind of compare with StashAway's approach, a quick walk through the systems, and then how they fared during the March event of 2020. And of course, I'll be leaving you with a few parting thoughts of how you can choose between them both. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending and investing. So let's start with the easy stuff that you should know about Endowus. Firstly, they use low-cost unit trusts to build their portfolios instead of ETFs. From a practical perspective, I don't really think this makes a huge difference at all to us. I believe one small drawback is that I can't really check the performance of each individual fund very easily. This is unlike you being able to pull up a quote, look at charts of any ETFs that you find, whether through your broker or through some finance site. One of the value propositions that they pitch to you in its site is that the unit trusts that they choose are lower cost and they rebate you some of the fees. However, when you compare the fund level costs with the other robo-advisors out there, the differences aren't really that big. Which leads us to the second point of understanding its fees. Endowus charges an access fee starting at 0.6%. But for me, because I'm putting my SRS with them, both SRS and CPF are invested at 0.4%. StashAway is at a greater disadvantage here because right off the bat, they charge you 0.8% as a starting fee. And there is no distinction between whether you want to invest cash with them or SRS. However, as your account size grows, the gap between the fees tends to drop a little bit. So for the fund level fees, I'm currently paying about 0.39%, and that of course is the fees that you're paying towards the unit trust managers itself. And this is ever so slightly cheaper than the 0.4% that StashAway promises you at the fund level fees. But net, I think Endowus is a clear winner when it comes to saving a bit more when it comes to total fees. Next is that the funds that you invest with them are not commingled with other different accounts, nor Endowus's own funds. It's 100% yours and it's custodized with UOB Kay Hian. And this simply means that in the unlikely event of a shutdown of Endowus, the account you hold, the assets that are within it are still maintained within that account. So you have total freedom and decision of what you want to do with it. In comparison with other robo-advisors and perhaps StashAway, what happens is if the robo-advisor shuts down, it is forced to sell all the assets and then return you cash. On the surface, it's not really that big a deal because your funds are still safe, right? But it's just a scenario where you might be forced to take a loss in the event that the timing is wrong and they try and liquidate all those assets. Next is that the interface that Endowus has currently, it's only on its website and they have no app, unlike StashAway. But to be honest, is that a big deal? That's really up to you and your lifestyle. And the final point, which is important, but I won't really go into too much detail, is they have some excellent customer service. And I do think that this experience that I have with them is somewhat similar to what StashAway offers. They're both really good in onboarding customers. The entire journey is smooth and seamless. They're great in creating content, and on top of that, they're really engaging with the community as well. And speaking of engagement, what really helps my videos out is that if you choose to be generous and click on that like, subscribe, maybe that bell button, because what that tells the gods of YouTube is that this video, yeah, it makes some sense, it has some value, and it helps them push it out to more people as well. So that'll be really helpful to me. Thanks. So with the easy stuff out of the way, let's get deeper into what are the key differences between their approach versus StashAway, starting specifically with how you choose your risk index. So Endowus offers you 6 core portfolios which are back-tested with roughly 15 years of data. The portfolios are fairly simple, which is really just between equities and bonds, and it's your choice between the ratios of them, which is what makes up the 6 options. However, the risk associated with each of these portfolios aren't clearly outlined, at least in the public side. It gets much clearer when you start building the portfolio itself. Nevertheless, I've linked it below if you wanted to just see it from the outside. The way they explain the risk is that it is based off the 15 years of data which they have, and they conduct a simulation using a 12-month rolling period to look for what was the maximum loss during that time. Now, before your head explodes, it simply means that in this simulation, they started a new investment every month for that entire 15 years, and each experiment lasts for 12 months. So what they're looking for is that which month did you have to start stretched out for 12 months that experienced the worst possible loss. So for the 100% equity portfolio which I chose, the maximum potential drawdown was 44%, and that's if I would have invested back in 2008 as a starting point. Now 44%, that's a really scary number, but just bear in mind that this was one single point in history in the worst possible case scenario of you starting your investment back at that one period. Just bear in mind that the total long-term performance of this specific portfolio is still a very solid 7.85%. And in the case of the StashAway risk index, I chose the 36%, which simply means that there is a 1% chance in a given year that your portfolio might lose more than 36%. While both robo-advisors do have the information of what kind of risk that you will be taking, I find that StashAway's approach is a little bit more straightforward in trying to help me to understand what kind of risks I'll be exposing myself to. But enough about theory, let me give you a quick walkthrough of what the systems look like and what my portfolio looks like as well. Hey guys, welcome to the Endowus dashboard. But more importantly, let's dive into the portfolio itself. So like I mentioned, the portfolio that I chose was 100% of equities, and it's nice that they've kind of broken it down very clearly in terms of information. You've got the top 10 holdings that you have. You've also got the top 10 countries. As you can see, it's quite heavily weighted towards US, and you've got sector allocation as well if you're interested in that. Where the meat and potatoes are is really here, where you can see the portfolio construction is only 4 funds. And primarily, it's kind of got a backbone of the S&P 500, but the Global Core Equity Fund over here, and this is a dimensional fund, and that's a really kind of a very reputable provider of unit trusts, low cost, fairly academically driven. This is a really key sentence. So in line with dimensional funds investment philosophy, they are overweight on proven factors. It's overweight in terms of small size companies, value-oriented companies, and profitable companies. So as you can see, that forms 70+% of the portfolio, with the remaining percent in emerging markets and Pacific Basin, which includes countries more like Japan. And this is what the 100% portfolio looks like, and it doesn't change over time. So the other thing worth mentioning is the model asset allocations. So here's where if you click in, you can get to see the historical performance of all the different portfolios that they have. So specifically, if you wanted to look at what I have, which is the 100% portfolio, you can see its performance across all different time frames, and you can see the type of returns that you might be getting in the different time periods and the different holdings as well. One question that some of you might be asking is, how did this portfolio do compared to StashAway during the drop in the stock market in March? Encouragingly, this portfolio that I have with Endowus experienced a 19% drawdown, and this is versus StashAway's 30%. However, to date, StashAway's portfolio has returned roughly 15+%, and this is compared to Endowus's portfolio, which currently is about roughly 10%. So the difference in performance isn't really that small. A 5% plus gap, I think that's something that's relatively significant to a point where I will want to keep a tab on it. And it's because I want to see the performance difference between StashAway and Endowus over a longer period. And the reason why is that both these robo-advisors have very different approaches to their investing philosophy. For Endowus, you can describe their investing philosophy as passive and academically driven because they focus on these things called factors. To super simplify it, Academic research simply points to these things called factors that explains why stocks perform the way they do. So there are many factors out there, but the ones that have been most rigorously tested are what Endowus uses to tilt its portfolio towards. And those factors are smaller size companies, companies that have been valued reasonably, and those that have reported growing profits. In more technical terms, those factors are called size, value, and profitability. The other thing you should know is that the ratios that you choose up front are fixed, and it's not something that's dynamic and shifts over time, which is why their approach is passive. The only modifications that are done are rebalancing. If some of your funds become out of line, they just bring it back to the ratios that were original. In comparison, StashAway's approach is relatively active. In the past 3+ years since they've been operating, they've actually modified the portfolio construction already about 3 times. Their model is called ERAA, which I won't really dig into, and I'll just link it down below, so if you wanted to read more about their philosophy, you can do that. So I might have gotten a little deep into the woods there, but I nevertheless thought it's really important that you understand why their approaches are so different. But it all boils down to a very practical question. How do you really choose between them? I'd say ultimately it boils down to 3 factors, which are cost, convenience, and approach. Cost-wise, like I mentioned before, Endowus is a clear winner, especially if you're investing your SRS funds with them. However, if you're investing cash with them, the cost differences drops a little bit more, and especially towards larger account sizes. Convenience is another factor. Endowus is a clear winner here again in the sheer number of products that if you wanted to use it, you could use it as well. So if you're the type that likes to consolidate all your investments, CPF, SRS, cash, money funds, then yeah, Endowus will seem to be a natural choice. The final factor is approach. Which of this is best? So if you are the type that happens to be academically inclined, Endowus' approach really might be up your alley. If you believe that the combination of technology as well as brains can produce you better results with a little bit of active management, StashAway might be something that suits your style a bit more. So the bulk of the review is done, but there is one more small bonus section that I wanted to add on to this, and this is related to its performance and those factors that I mentioned a bit earlier. So this is me being a speculative YouTuber, amateur investor over here, so take it with a pinch of salt and a huge asterisk, okay? For some of you guys, you might be thinking 7.85% annualized returns over the past 15 years? That's not really that impressive. The long story short is that those specific factors that I talked about earlier, which have been academically researched, is very rigorous, specifically size and value, have not been doing very well, specifically in the past 14 to 15 years. And this is in comparison to larger size companies as well as growth-oriented ones. So how long more will this outperformance last? Nobody really knows, but the gap between growth and value is at its widest in history. Some people theorize that the gap will actually correct itself, and who knows, maybe it will. But I've really been observing that small cap stocks are really doing much better than its growth counterparts, especially in the past month and maybe even towards 3 to 6 month period. Now, I'm not sure if this phenomenon is the return of the glory days of small cap value stocks, but if it is, Endowus' future returns might look really bright. So I hope you guys found this review useful, and if you did and you're feeling really generous, I happen to be a customer of both of them, and I've got referral links down below. So if you wanted to and you use those referral links, naturally there's a win-win situation. You get some money off, I get some money off the management fees. If not, a simple click on that like, subscribe, as well as that bell button will be equally helpful as well, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.